Welcome, everyone. My guest today is Rohit Chopra, the director of the Consumer Financial Protection Bureau, to talk about junk fees, the new AVM rule, the Public Orders Registry, and more. Director, welcome to the podcast.
Thanks so much for having me.
Great to have you on here. It's a pleasure and we're excited. So I'm just going to jump right in and ask about some of the CFPB's recent actions when it comes to mortgage lending. This is such a tough time for lenders. As you know, we have high mortgage rates and high home prices really affecting volume. So from a lender standpoint, the CFPB's focus on closing costs right now with its recent request for information, and especially labeling some of those costs junk fees, feels like bad timing. What would you say to that?
Oh, that's funny. We hear literally the exact opposite. So what lenders are telling us in the marketplace is that so many times they're struggling to really get their volumes that they would expect because of the challenges borrowers are having in getting to closing. It's not just rates, it's also how much money people can bring at closing in terms of down payments. Our own analysis shows that there really are challenges that borrowers are facing, and ultimately lenders are seeing that every day. I'm also surprised to hear you say that, Sarah, because lenders are constantly coming to us and complaining about all of the fees that they're getting stuck with, which they ultimately have to pass on to borrowers. They tell us so much about these credit report and credit score fees that have gone through the roof. They tell us about even employment verification fees and so much more. So I really think this is so important, especially in this high interest rate environment where every dollar is counting. I'm really worried that so many mortgage lenders aren't really making much money, and that could lead to a much more consolidated market structure that ultimately gives less choice to people.
Yeah, I think there's certainly common ground around the rising costs of things like credit pulls, things that are passed on to the consumer. But the idea that the lender fee, for instance, is a junk fee does not sit well with lenders. Or even the fact that these closing costs are being brought up again when lenders just went through a process a few years ago to really settle this. So you have the American Bankers Association, the Housing Policy Council, the MBA. They've talked about how these fees are lawful and have been lawfully disclosed too, and suggested that maybe the right way to go about changing things is a formal rulemaking process.
To be honest, Sarah, you're talking about something that I think most lenders won't even know what you're saying. I think what lenders are trying to deal with is closing loans for the customers that they serve. We don't have a rule to propose. So I think that it is true. You hear a lot of the Washington lobbyists really defending the status quo. We have seen that on so many fronts, but things are not going so great in the mortgage industry right now. We are seeing volumes tumble. And it's not just refinances. There's so many ways that people are not able to get a mortgage. That's not just bad for those homeowners or for those local economies. It's also tough for the mortgage industry. So we're seeing how the biggest players in mortgage are getting bigger, and a lot of independent players are really struggling. So we have to really figure out, what are we going to do to make it so that there are not a lot of middlemen and gatekeepers in the system who can really punish both consumers and honest lenders with ripoffs and fees. And that's really what we're going to do.
So, Director, I think at the heart of this is exactly what you just said about volume. It's down so much. And when you look at that, anything that makes it harder to manufacture loans is going to drive cost up. It's not in anyone's best interest for lenders to have it so hard that they just stop lending, right? So, that's not good for consumers to have less choice, and it's not good for pricing. So how do you balance out what's going to help consumers that might also be hard on the industry? How do you balance those things?
Well, I think we want to avoid, obviously, the worst of the abuses that occurred in the lead up to the financial crisis, where we saw set up to fail style mortgage lending that unfortunately was in too many corners of the country. And most mortgage lenders fully agree that there has to be some common sense safeguards. But this is really the first time we're navigating this really different rate environment. If you look at just 2 years ago, the dramatic change in rates has really made the difference in the math across the country for so many people. So what do you do to think about how to create a resilient and sustainable mortgage lending system that doesn't go really through boom and bust cycles? I think now is the time for more thinking about what are the impediments that especially small and independent mortgage lenders are facing. Too often, we think, well, you know what? I hear this all the time. They can just go away and go into a bigger player. I'm just not sure that's a great answer. We obviously have multiple mechanisms for those small lenders to be able to have liquidity, to participate in various programs, whether it be the enterprises or other government programs. And of course, there's got to be some basic rules of the road against fraud to make sure that the capital markets can price loans. But we can't just protect the status quo forever, because otherwise we're going to see a different mortgage market that we may not be so happy with in 20 years.
No, absolutely. Let's talk about technology's role in making some of these things easier for even smaller lenders. To that point, let's talk about the new CFPB rule around AVMs.
So, yeah, I think appraisals is such a big issue. We want to make sure, and we saw this, 15, 20 years ago, the problems with overvaluation. And then we've also seen issues when it comes to appraisal bias and others of undervaluation. We really need accurate appraisals. And that's really how the CFPB thinks about it. And of course, human appraisals and machine-driven appraisals are going to be part of the market. So one of the things we've done is try to make sure that those algorithmic-based appraisals, particularly as there's going to be advances in artificial intelligence, have really some checks on them when it comes to conflicts of interest, when it comes to bias. And I think we put forward something pretty common sense to make sure that artificial intelligence and algorithms don't just favor some people over others.
Yeah. So, I do think that AVMs are one of those issues that we can really see common sense wise. If you think about all of the properties that were valued during the refi boom that we had, so many properties went through that process. We now have a lot of information on them. How does that work into what you want to do with AVMs?
Well, I think our work on AVMs is really just about accuracy, but I think you're asking more broadly about the role of technology and how automation is really going to be even more part of the plumbing of the mortgage system. I think we heard a lot of concern around some of the big vendor and software technology mergers and consolidation. We always are hearing from mortgage lenders about ICE. I think there is a growing power of a lot of these big technology providers, and that's not unique to mortgage. We're seeing that with small banks, very dependent on a couple of big software platforms. We see it with auto dealers. We see it in all corners of the economy. And I think the big question is, who's really going to benefit from automation? Is it going to be broadly shared, those benefits with consumers and lenders? Or is it just going to create a couple more gatekeepers who can levy a tax on every single mortgage in the country?
So, what do you think the CFPB's role in that is as you see that? So, the ICE merger, for instance, was approved with some changes that they made. Rolling out some different parts of their the Black Knight universe to other companies. So, what do you think the CFPB's role in that is?
Well, understanding mortgage tech is really key. And one thing I'm hoping that more in the mortgage industry can help us think through is, what is the digital future of the mortgage market. And as many of you know, the CFPB has been putting into place more rules to promote what's known as open banking. Open banking is the possibilities of having a more frictionless and more competitive banking system for financial products. We have started that process by giving consumers the right to permission their bank account data, their transaction account data, to permission it to various types of lenders. But we're trying to think, what are the ways to make the mortgage system benefit from open technologies? One of the ways we might address the issue of the price gouging on credit reports and credit scores is maybe thinking about how consumers may be able to permission their credit reporting information directly to lenders, or to be able to provide their cash flow in new ways to lenders to provide for different ways of underwriting. There's so much of this already going on in the industry today. And I think we want to make sure we're supporting all the efforts that are helping consumers and lenders, but not just concentrating power in a couple of big technology companies.
I know we just have a few more minutes. I'd love to get to the public orders registry that you guys just established with a new rule, and it's tell us a little bit about that. So, I mean, this would report mortgage companies or lending companies, servicing companies that are repeat offenders. One of the questions that I've seen from different industry players is, why do we need this when we already have that complaint database? We already have a whole setup for this kind of reporting.
Well, sure. I know repeat offenders out there don't want any more spotlight on them, but it is a huge problem in our financial industry. I think we've all seen the rinse repeat cycle of some very large financial firms breaking the law over and over and over again. But we also see various scams that are in one part of the country, they get shut down, and then they pop up somewhere else. So what we're trying to do here is to create some real information that law enforcement and others can trace to determine where those actors are and how to make sure that local, state, and federal law enforcement can make sure they're following those orders. So this is really important, I think, in the mortgage industry, because mortgage lenders, mortgage players all over have seen the scam artists that pop up in order to take advantage of people, and who ultimately can sow distrust with consumers that they're dealing with. Many people, and we hear it a lot, even in the context of trigger leads, they're getting all sorts of calls from people they've never even heard of, and many of them may not really be offering them a product they want. So it is so important, Sarah, for us to contain these repeat offenders. And I'm really glad that a lot of the honest companies out there see that they are disadvantaged when some can repeatedly break the law.
When you set up something that's just for non-banks, or you include non-banks in it, it raises the question that I think a lot of people in the IMB world have, which is, do you think that non-banks are less regulated, that they still are in need of more regulation? Because what they would say is, like in this particular example, you have the Conference of State Bank Supervisors, you have a lot of people who already regulate non-banks. Do you feel like this is another way that the CFPB is saying that, non-banks are riskier?
Well, our legal authority focuses on those non-depository players. We actually know the list of insured depository companies, but when it comes to so many debt relief providers, all sorts of alternative lenders, we don't even have a list. But you're right, though, that when it comes to the mortgage industry, there has been so much when it comes to state oversight and licensing. So I don't expect our repeat offenders database to really be focused on mortgage. But really, we're going to see a lot when it comes to all sorts of financial scams that are out there.
You're charged with protecting consumers. So, what keeps you up at night?
I will say this. We saw last spring how rapidly the failure of Silicon Valley Bank occurred. We also saw within weeks many other challenges with other financial institutions, the failure of First Republic, Signature, and of course, the major issues in Switzerland at Credit Suisse. So I do think that the mortgage system is so heavily dependent on the broader financial system that one trouble in one corner can quickly gravitate throughout. So that is always a place where we have a lot. We want to make sure that we're on top of it. And that means thinking about the role of really the shadow banking system. Another place I think a lot about, Sarah, is big technology outages. We have seen this in a few different areas right now. A lot of in the automotive industry, a lot of auto dealers are dealing with the panic related to the issues at CDK. We saw pharmacists who were really struggling all over the country with the outage at Change Healthcare. If you look at the mortgage industry, there are a couple of vendors that really are essential facilities in the plumbing of our mortgage system, and an outage could really create chaos. So, there's a part of a regulator's job is to worry about what things others are not worried about. But those are just a couple of things that are always on our mind that could really create trouble for the whole economy.
Director, I know you have to go. Thank you so much for taking time with us today. I hope to have you back on soon.
Thank you so much, Sarah.